Sourabh Mukherjee joins us. We always look forward to engaging conversations with him. Sourabh, thank you for joining us. Has anything changed in your approach, in your portfolio, in your outlook post the budget?
Not really. I thought the budget was a no-nonsense budget. The economy continues to open up. I think the first time in 2 years, my kids are going to school every week. So that's an undecided positive, if you ask me, not just for my children, but children all across the country and the entire ecosystem of vendors which survives by catering to our schools. So the economy is improving. The fiscal position is better than I thought it would be. Honestly, I think that the budget painted a far better fiscal position than I thought it would be. The short-term items that you mentioned around oil prices and bond deals are there, but we've never really lost too much sleep about that. Our focus has been invest in strong, well-run companies and benefit from the underlying compounding and great franchises in this massive economy.
I fully endorse that idea. Saurabh, you don't look at macros when you invest. You look at individual companies and your understanding of the business. That's the unique aspect of Marcellus. But macros do matter. If cost of capital goes to 7 or 7.5, it will have an impact on demand. It will have an impact on valuations. It will have an impact on flows. At what point in time you would say that, look, while I continue to focus on micro, which is individual companies, the macro for me is something I cannot be now ignoring?
So, Nikunj, there's two ways to understand macro, right? The way we understand macro is the structural story. So, for example, India's 10-year government bond yield in 2004-2005 was 17%. Today, it is 6.7, and we are fretting that it might go to 7, right? So that for me is macro, that you have a structural downtrend over 10-15 years, a 10 percentage points drop in your cost of capital. That's what transforms countries. And if I look at that structural type of macro, I don't see what I should exactly lose sleep about. The financialization of our country continues. Your channel, your viewers, our clients are all proof of that financialization. As financialization continues, cost of capital structurally continues to go down. Sure, there will be a Fed hike, 3 Fed hikes, 4 Fed hikes, but that's not going to be a structural story. Those are cyclical waves, and our job is not to second guess. And nobody who's watching this should be trying to second guess cyclical waves and trying to make money from that, because that is an absolute fool's errand. Focus on the structural story. Absolutely, macro matters, but structural stories matter. The cyclical stories, the noise is oil price, aaj kya hai, what will be the oil price next week, next month. That doesn't matter so much. It doesn't matter for 2 reasons. A, that is a mean reverting story. It's a cyclical story. There's plenty of noise in the oil price. And B, structurally, the oil price is not going to stay high, nor will it stay low. Oil prices structurally tend to hover around $50 to $80. So focus on macro stories, which are structural, rather than noise macro stories, rather than cyclical macro stories.
So just for the benefit of our viewers, I know we've discussed this much, but this topic keeps on coming out again and again. There is nothing wrong in buying good quality businesses, but good quality businesses may not be this great stock. And the classic example, which you've spoken about, which you've defended, which I've defended, which everybody knows, but for those who don't know, is that Unilever example. भाई एक समय था Unilever 10 साल time wise correction में गया. Company went through okay growth, but the stock did nothing. Could that be the story for HDFC Bank? Because last 2 years in a bull market, the stock has underperformed. Last 1 year returns are negative.
So people keep citing these stories. I think another one story I keep getting is Infosys ka share price in 2008 was the same share price that it had in the year 2000. And we keep hearing these stories. If you see the Indian market in the last 20 years, you and I will struggle to find any company, and I'm happy for people out there to send us proof in emails. In the last 20 years, I haven't found any company in the Indian market where PAT grows at 20% year after year and the share price doesn't grow, for obvious reasons, right? If a company is delivering PAT growth of 20% year after year, then every 4 years, basically the company is doubling the business, doubling the PAT, and it'll be crazy for the stock market not to take heed. What you do get, Nikunj, I completely admit, is if a great franchise becomes a mediocre franchise, if a great franchise underperforms from a business perspective, the PAT stops growing at 20%, the PAT becomes single-digit PAT growth, then obviously the share price stagnates. So the point we all have to recognize is, if we from an investment perspective, if we get the quality wrong, i.e. we thought this is a great franchise but actually it's a mediocre franchise, then of course it will underperform, and that's the main risk to our style of investing. And it's a risk we have to be very vigilant about, that we are genuinely investing in companies which continue to be producing great results. And if the results are mediocre over an extended period, obviously we will underperform. And that's the reason I focus on the business rather than focusing on the stock price. The stock price tells us nothing. It's one of the biggest ironies of investing. The stock price has zero information value.